Before you make a decision about whole life insurance, you need to know this crucial detail. Let's be real, nobody wants to feel that dreaded buyer's remorse, especially when it involves trusting someone who didn't have your best interest at heart. Before you buy a whole life insurance, you need to understand that it is not an investment. What do I mean by that? Whole life insurance doesn't carry the same risks as stocks or mutual fund. Imagine buying a stock at $100 and it drops to $60 the next day. That's a risk you accept with investments. But if your savings account balance drops from $100 to $60 without you spending a dime, that is a problem, right? Whole life insurance is more like a savings account with some extra features such as death benefit and tax savings. Often, people compare the rate of return of whole life insurance to stocks or mutual funds and declare it a bad investment. But that's like saying a savings account is bad because it doesn't yield as much as the stock market. It's an unfair comparison. Whole life insurance should be viewed as a savings vehicle, not an investment. Is your savings account supposed to be the stock market? One of the biggest issues with whole life insurance is the lack of education from agents. Some agents pitch it as a fantastic investment, which leads to misunderstandings and disappointment. If an agent or a family member is convincing you to buy whole life insurance because it is a great investment, think twice before you buy. So much of the hate and disgust around whole life insurance simply boils down to this. Coupled with the fact that some agents design these policies to maximize their commissions, I will agree that some policies can really be bad, and I will show you an example later. But if you approach it as a savings account with uninterrupted compounding and tax savings, and you compare it to the other alternatives out there, over a long period of time, very few come close to the benefits it provides. I believe in a balanced approach to finances. Have a mix of savings and investment. Use a type of savings account for money you cannot afford to lose, whether it's high yield savings, whole life insurance, or CD, and invest the money you want to grow. If you are comfortable putting all your money at risk in the market, that's great. Everyone gets to decide how much risk they want to take with their money. But to compare a savings account to an investment, I think that is a wrong approach. Let's take a look at this example. A 30-year-old male who has decided he needs an emergency fund of $30,000. He's not willing to risk this money in the market, so he's going to contribute this money into some sort of a savings account. Let's start with a whole life insurance. He will contribute the $30,000 into the policy over a period of 7 years. If the policy is designed poorly, this is how the numbers may look. First year, he's contributing $4,286, but not much shows up in cash value, just about $142. This design lacks liquidity upfront, which means there is not much cash value to borrow. If life happens, you are in big trouble because there is no cash value to borrow. This policy doesn't break even until between year 11 and 12. Break even meaning when the cash value is equal to the amount of money paid into the policy. This is a bad design, and these are the type of policies you want to avoid. Now, some agents will say, but in the long run, everything will be fine. Yes, in the long run, it may be fine, but the risk is that a consumer may feel deceived based on what they are seeing in the early years of the policy and may stop funding the policy because the money they are putting into the policy is not showing up in cash value. Why should an agent receive a big commission upfront because of a bad policy setup and make you hope in the long run? I don't buy this argument. Now, let us take a look at a better alternative. Same person, same contribution, same company, same product. The only difference is the design. We have reduced the base premium and the rest of the money goes to the paid up addictions or PUA. By the way, an agent's commission depends mainly on the base premium. You can check out my other video on policy design to learn more about this. I'm going to put it somewhere up here, or it's also going to be in the description below. If you look at the numbers on the right hand side, you can see that the cash value in year 1 is about $3,500. We have enough cash value to borrow if life happens. The break even happens between year 5 and 6. By year 6, we have paid in a little over $25,000 into the policy, and we have more than that in cash value. After year 7, no more contributions are made into the policy. We have contributed $30,000 into the policy. Over a long period, the cash value continues to grow steadily. You can access this money anytime you need it, just like how a line of credit works. Now, let's compare this to a savings account. We are contributing the same amount of money into a savings account. This page represents the whole life insurance. We have the year and age in the first column, beginning of year net cash value, and the amount of money we are contributing in the policy in this column. We are contributing $42.86 a year for 7 years. That's a total of $30,000. And then we are done funding the policy. This column represents the cash value increase. Now, I want to be very clear here. It does not necessarily mean that the cash value is growing at this amount. All that it means is that we paid in $42.86, but this is the amount of cash value it turns into. So year 1, for instance, we paid in $42.86, we get $34.95. Year 2, we paid in $42.86, and it converts to $4,112 as cash value. This column represents the end of year net cash value, and then this is the death benefit column. These are the same numbers that we saw earlier on the Excel sheet. Let us take a look at the savings account. I am assuming that it earns a fixed interest rate of 3% every year. I'm also assuming that any gains at the end of the year is taxed at 20%. For example, in year 1, you contribute $42.86 into the savings account, which ends at 3%. That's $129. When a 20% tax is deducted at the end of the year, we will have an account value of $43.89. Now, let us look at a side-by-side comparison. We have the savings account in this column and the whole life insurance cash value numbers in this column. So right out of the gate, we can see that the savings account has a higher balance than the whole life insurance. This is not surprising because savings accounts don't have any expenses. Whole life insurance, on the other hand, has relatively high expenses upfront because of the cost of insurance and the commission paid out to agents. It is not until year 10 that the cash value in the whole life insurance exceeds the savings account's balance, and from that point forward, the difference just keeps growing. Now, I know some people will say, well, high yield savings today are paying between 4 to 5%. That's a fair point. But the question is, for how long will this go on? Even if I change it to, let's say 4%, still the whole life insurance is going to do better at some point. Even if I go to 5%, at some point the whole life insurance is still going to do better. Now, the question is, what is the probability that you are going to earn 5% every single year on your savings account? Over the last 20 years, average high yield savings account is about 2 to 2.5%. So even though the rate is higher today, over a long period of time, I think 3% will be more accurate than 5%. Also, should you pass away, your beneficiaries will receive a higher amount of money from the whole life insurance policy than a savings account because of the death benefit. Whole life insurance is a better savings account, but it is not an investment. The key thing is that the policy has to be set up properly. It has to be set up with minimum commission and expenses, and this is something that I can help you with if you are considering getting a policy. Thank you for watching, and don't forget to like and subscribe for more videos like this. Bye.